today's video was about National Financial Literacy Quiz. This video plays was about National Financial Literacy Quiz, a joint initiative by NISM and SEBI. For more information, you may visit our website, that is nflq.nism.ac.in. So myself, Tanisha Bhandari, working in Investor Education Department of NISM. NISM is the capacity building initiative of SEBI. We at NISM conduct wide range of activities at various levels with the objective of improving quality standards in securities markets. At NISM, we work in 5 broad areas: long and short-term academic programs, certification for market intermediaries, e-learning programs, training programs for working professionals and academia, and various investor education initiatives. Today's webinar topic is equity investing, the path to create lasting wealth. So for this, we have with us Yogin Sabnis. Yogin sir, one of the world's leading financial planners with over a decade of experience in guiding business and family financial well-being. He is the co-founder and managing director of VSK Financial Consultancy Services Private Limited, a SEC-registered investor advisory firm known for its high ethical, innovation-focused, and client-centric approach, a chartered financial planner, and a member of Future Financial Planning Board. Mr. Subnis has played a pivotal role in shaping the future financial planning paradigm since its inception. He is graduate of Royal College of Management and holds a postgraduate degree in banking, investment and finance, and is member of the Cornell College of Life Planning's 7 stages of money maturity framework. Now over to you, sir.
Thank you, Tanisha, for this flattering introduction. Can I now just open my presentation? Yeah. Right. Okay. So good evening, everyone, and welcome to this session. I have done these 1 hour sessions multiple times, and I'm sure some of you have at least attended these kind of sessions earlier also. But the important thing here is that once the session is over, what are your learnings, whether you implement those learnings. It is important to take note of these things so that, this 1 hour becomes fruitful for you. So I want you to take the full advantage of this 1 hour, and I will be speaking on a lot of things, and there would be doubts and questions in your mind. I would want you to put those questions up so that they could be answered after the session. So the way it would work is that I am supposed to talk for 45 minutes and take you through the presentation. And then the last 15 minutes will be to answer your doubts and queries. So please be sure to voice that, so that you don't go, after the session, all your queries are answered. In fact, if it takes more than an hour, I am willing to stay back and see that I answer all your, queries. The topic of equity, which is the instrument to create lasting wealth, is such an important topic, and I want to emphasize. In fact, if I were to retitle this particular topic, I would have said that it is the only path to create not just lasting but intergenerational wealth. So here what I am saying is that equity has the power to make you completely financially free, and provided you do certain things, right? So let's get on to the with the presentation. So the first thing is, It's, what I'm going to talk about are simple common sense things, but they are, even though they are simple, they are not easy. So, this particular statement that I have put up is about savings by amount. It is not about the amount you earn, it is about the amount you save. Now, I have two very glaring examples, which actually brings out the difference. So the first example is my masseur who comes to give me a massage every Sunday. Now his full-time occupation is that he is a driver, working. He works as a driver with someone, and this is his weekend jobs. What he has done is he has he's not even SSC pass, but he has understood the basic concepts of investing. He does SIPs very diligently, and today he has, I don't know, he has been doing this for last 12-15 years maybe. And today he's not investing with me, so I don't know the exact details. But from our conversations, which happen, quite often, he has told me that today he's worth 40 lakh rupees. Now, and he's in his early 40s. So imagine a person with such a low income who's diligently saving and already has created a corpus of 40 lakhs for himself. Whereas the other extreme example that I have is a prospect whom I had interviewed, who had come through an existing client of mine. This guy was earning, he was in the infotech industry, he was earning upwards of 50 lakhs a year, but his lifestyle, his spending habits were so bad, he did not even have, same age, okay, but he did not even have 10 lakhs rupees, as to show off as his assets. So, this is the most important thing that you have to remember, that this is the first step, a diligent savings. Okay. So the saving habit, uh, so the difference in the saving habits of the two examples I gave are very clear. It is very easy to, sort of inculcate this habit. In fact, we Indians are most of us have that, sort of inherent in us. So all you have to do is, if some of you are those who spend a little lavishly, all you have to do is make a monthly budget of your expenses, see where you are spending more, try to curb that. First, take out from that earnings that you have, first take out a portion of that money towards savings, and then within the remaining amount, you try and fit your expenses. So, but only here the thing is that saving is just not enough, because saving rate, if you keep the money in the bank, the saving rate is less than inflation. So you need to invest the savings appropriately, right? So so we are going to talk about inflation and then the compounding effect and so on. So I have a very interesting slide here, just a fun fact, sort of, to show you. So this is the Taj Mahal five-star hotel in Bombay. It opened in 1903. The room charges at that time was rupees 6. Okay, today it is upwards of 15-20,000. So over a period of time, how the expenses creep up, this is an example of that. Then we actually come to the details about inflation, how it sort of erodes your wealth. Um, right. So this is the graph which shows that if the inflation is at 6%, how your amount gets eroded, the value of the amount. So for example, today if you have 1 lakh and if you keep that 1 lakh as it is, at 6% inflation, just see how the value erodes. Say after um, 15 years, it is around 40,000. 20 years, it is 30,000. And after 25 years, it's almost one fifth. So this is what inflation does to your money. And you many a times what happens is the inflation is such a slow killer that you would not even realize that the value is eroding. You will just start feeling that, I'm not able to spend the money or afford to do things that I could afford to earlier. Now, to counter this effect of inflation, what we have what is called as the compounding. I can call it as the antidote to inflation. Basically, what has happened is that this compounding that we are talking about is something that that gives you the power of increasing your wealth. Now, the only effective power, I mean, everything can compound. Just as inflation can compound, your FDs, interest, cumulative FDs can also compound. But the biggest power of compounding you will get is from equity, and that is the topic of today's discussion. So, just to illustrate the power of compounding, I have this story. And this story goes like this, that the inventor of the chessboard went to his king to show off his invention. And the king was so happy looking at it that he told the inventor that you can have whatever you want as a reward. So the inventor guy said that he would want grains of rice or stock of rice equivalent to something like this, that he said 1 grain of rice on the first square of the board, then double that in the second, which will be 2, then in the third there it will be 4, in the fourth it will be 8, and so on. The king thought that, it is hardly anything. I mean, it was he felt that the reward that he was asking was nothing, until they started to actually fill those grains. Now, remember, this chessboard has 64 squares. Long before that, the rice that was required was so much that the treasurer came and told the king that we have used up all our supplies from the go down. So that's the compounding. Now, if you can't wrap your head around these things, then I'll give you a proper concrete example. Let us look at this example where it is an investment which doubles every 5 years. Incidentally, the investment which doubles every 5 years is giving you around 14% return. So this table shows that, your 10 lakh has become 20 lakh in the first 5 years, then 40 lakhs after 10 years, 80 lakhs after 15 years, and 1.6 crores after 20 years. Now, what is the most striking feature of this? These are all 5-year periods. But the first 5-year period, you have made only 10 lakh rupees. And the fourth 5-year period, you have made 80 lakh rupees. In fact, if I extend it to 25 years, the fifth 5-year period, you will be making 1.6 crore. Now, this is the power of compounding. Now, this is something that you have to bear in mind, that the longer you are in it, the better the compounding effect. This is the biggest message that you should carry with you today. Now, let me also now talk about the investments. How do you achieve this? Most of you, if you are investing or, are being advised by, generally anybody, they will talk about, so there are insurance agents, there are bank RMs, various mutual fund agents. They all talk about schemes and products, and we have this which will do this for you and all that. So that gives that may confuse you a lot. Simply understand that the products, all investment products, fall into either of these buckets. So either they are a growth oriented asset, or they are an income oriented asset. So the growth oriented assets would be all this, stocks. If you have a company gives you ESOPs, you own a part of the company. Even if you are going into business with a friend, and partnership, that is also equity. And of course, equity funds. Also, real estate is there, but real estate is something that I will not recommend for people who are in the middle class category, because real estate, there are various things. I mean, for example, higher ticket size, there is no proper value recognition. I mean, the value, it's very difficult to know the value of a particular real estate unit at any given point of time. The opacity, I mean, it is not easily liquidable. And there are hassles of maintenance and upkeep. So for today's discussion, we are only talking about equity as a growth-oriented asset. As we said, the topic is of wealth creation. So equity is the only asset class which can give you wealth creation, right? Now, income-oriented assets are basically everything else: the fixed deposits, the bonds, PF, PPF, um, even gold. Because gold, because of course now it is in the limelight, because it has gone up quite quickly and to a very great extent. But if you see the history of gold, there will be number of years that the gold will not move. So on an average, if you take the gold, returns are somewhat higher than inflation. It is anyway always called that it is a hedge against inflation. So it won't do much more than a debt product, which are all these other fixed deposit bonds and other stuff. Now, if you have seen the difference between these growth oriented and income oriented assets, what you will realize is growth oriented assets are ownerships. You become a part owner of the asset that you are investing in. Whereas in income oriented assets, you are actually lending money. So you are only getting interest. You will never get anything more than interest. Now, the main point people talk about is that, okay, these income oriented assets are safe, and protection of capital and so on and so forth. So in the following slides, we will see how we can ensure that we have these kind of sort of features even in equity, although not literally, but I should be able to convince that it is also reasonably less risky if we do it the right way. So, uh, basically, what is equity investing? And rather than that, I would say, what are the traits that you require to be cultivating within yourself to see that you are successful in equity investing? So, the first thing that you are required is to have an optimism about the future. Now, what do I mean by optimism about the future? See, in last 40 years of my being in the business, I have seen umpteen number of natural calamities, political upheavals, financial disasters, and each and every time the markets have gone down. And when they go down, they people start panicking, and that is the time people behave very impulsively, and basically they are emotionally taking some decision, which is never a good decision. Now, if you know the future is going to be better than this too shall pass. This particular, whatever problem we are in, we will be overcoming that problem and we will see better days. That is the optimism that is required every time, right? And I'm going to show you in the next slides that how that has worked out even in the past. So, optimism about the future is the basic requirement of a successful equity investor. What is the next thing? That is patience. So, patience is basically, if you are optimistic about your future, you have developed that patience that, okay, when you say this too shall pass, you are saying that, okay, I have to be patient with the current situation. So basically, in these kind of times, sticking to your investment strategy, not taking any precipitate action, and basically what happens is in these times, all around people are shouting negative things. You will have the media talking about doomsday. Your friends, your colleagues are going to tell you that this is going to remain worse, and you don't know when it will when this will change. So as I said, I have come across so many times these kind of situations. But I will quote one recent example that we all went through, and that was during the time of COVID. Now, during COVID, if you throw your mind back at that time in 2020, around March, markets had crashed. Okay, this was something that nobody had experienced. People were scared to even go out of their houses, fearing some touch somewhere they can, they can be infected. At such times, and we did not know how and when the situation will change. So at such times, those investors who had shown patience and went through this period without panicking, they have benefited immensely, from their patience. And lastly, we have the discipline. Now, when I say discipline, it is slightly different from patience. It is like, when you're into your SIPs, not stopping those SIPs, or when you are having created a certain corpus, a decent corpus, which you are very happy with over a period of years, not succumbing to the temptation of withdrawing money for frivolous reasons. That is discipline. Now, how this works? See, this is my freehand diagram. It's a depiction of market movement over, let's say, 15 to 20 years. Okay. Now, what are the observations of this graph? By the way, I will show you a real graph which is almost mimicking this. So it's not something it's coming out of my fantasy. So, but it is easy for me to explain. That is why I always show this. Now, what we see here is that markets are volatile, so they will go up and down. That is the first observation. The second observation is that even though it is going up and down, the slant is upwards. So each peak, subsequent peak is higher than the previous peak. So markets are going up. Of course, they are crashing at intervals. So there is a downward spiral sometime. But after that, it again rises and takes a higher peak. Again, it may crash, but the second crash is much higher than the previous crash. So even the subsequent lows are higher than the previous lows. At some point in time, they are even higher than the previous highs. The lows are higher than the previous highs, earlier highs. So the game here is to remain patient with your investment. So now let us talk about an unfortunate investor who does not understand anything about equity, but he has heard everybody, he has seen everybody making money. He hears stories of stock market giving very good returns. So what does he do? He also wants to invest. But by the time he comes to invest, market is always at his peak. Okay, invariably. Now, after he has done his investment, he sees the market crashing. The market has come down and he has panicked. But if he comes across somebody like me, I will tell him to, be patient and rest assured that one day he will see that the market comes back to its original level and he gets his break even. If he waits furthermore, he will see that the market again goes to another peak and he makes the return that he's aspiring to make. Okay. But this is over a long period of time. And the only virtue he requires is to be patient about it. This is what is required in equity investing. Now let me go to the some actual graph. Now this is the BSE index graph. Okay. If you see, I told you 15, 20 years. So if you see these, let's say 20-year period, you'll actually see what what I had depicted in my freehand drawing earlier. Just see. It has gone up. Every subsequent peak is higher than the previous one, and so on and so forth. So, so I want to narrate some facts about the equity market. Okay. Sensex started in 1979. It is not depicted here, 7980, at 100. Today it is around 85,000. So it is like 100 rupees becoming 85,000 rupees without you doing anything. Okay, just invested in the index. Now, this actually turns out to be a return of 16%, right? You did not ask anyone, you did not take any advice from anyone, you just invested in the index and it has grown so much. Then some of the conclusions would be that longer the time frame, the lesser is the chance of negative returns. Longer the time frame, the higher is the chance of you getting better returns. Another thing that you will see is, and this is something that worries a lot of investors who are in the market. So this is a statistic that you must remember, that equities always decline 10 to 20% every year. Sometime during the year, it will decline by that much. Okay. But if you see the statistics, in 3 out of 4 years, the market is up from, then when it started. So 75% of the time, market is going up. Okay. Then every 7 to 10 years, there is a huge decline, something like COVID. Earlier there was also some financial sort of declines or financial calamities that happened. 2008 was one, 2000 infotech bust happened. So there is something or the other, happening every 7 to 10 years when the market will fall big time, and that is the crisis situation, so to say. Um, so these are testing times, and when people panic, you should remember this graph, and sort of fix in your mind that this is just a temporary situation. I need to have patience. Market will always go up, and in fact, there could be a situation where you can at such times, instead of thinking of it as a calamity, you should, if you think of it as an opportunity, then you may even want to invest it in those times, and you will benefit big time. So I just want to show you a couple of more graphs about these market movements to just emphasize the point that long term is the best way to invest in equity. I mean, the focus should be long term. This is a 1 year moment of the index. And you see that it is going nowhere. I mean, you just don't see any trend here. It has, slightly shown upward movement. That's it. But it has been very volatile, up and down, and you can't make out where it is going. But if you see a 25-year graph like this, it is a clear indication that the market eventually goes up and rises higher and higher. Okay. So by now, I am hoping that I have been able to convince you that equity is the best option to invest through to create wealth for yourself. Now, the question is, when I say equity, how do you invest? So basically, there are two ways that you can do it: by putting money directly into stock market, buying shares, or investing through equity mutual funds. So this is a sort of a comparison as to how it would be. So let me look at direct stocks. So direct stocks, you are going to invest into those stocks yourself, which means and you don't have the expertise. You have your own work, your own business, or job that you have to work at for full time. You will have to spend more time on research, on looking at each and every company, deciding. But even with research, I don't know whether you will have the expertise to do it, right? So basically what you are doing is you are following somebody else who is recommending to you. You do not know how much of an expert that somebody else is. So you end up buying those recommendations. Secondly, what happens is you can't just buy one stock and keep at it. You will have to have a sort of as a diversification measure, at least 10, 15 stocks. So selecting one stock is difficult, 15 stocks will be 15 times difficult. And then managing that, looking at them, knowing when to sell, it's just impossible. I mean, because there are so many things happening. Now world is becoming a global village, as they say. So something happening at the other end of the world may affect your stock, and which you wouldn't even know why it is going down all of a sudden, right? So and the last but not the least is your emotional risk. A particular stock going down, you do not know why it has gone down. You will panic, and maybe sell when shouldn't be selling. Or sometimes people go the other way. They try to average out and buy more when actually you shouldn't be buying. So all these things, all these complications are there, which you are not really required to go through, but because you have this beautiful institution of mutual funds. Whatever professional management is required is provided by them at each scheme. When you invest in one scheme, right, you, even if you invest 5,000 rupees, you become a part owner of at least 30 to 40 stocks, right? Then one more thing that is not mentioned here is the capital gains. Every time you sell a stock, you sort of incur capital gains, and so you have to pay tax on it. When the fund manager does it, you don't have pay any tax. If the fund doesn't pay, you don't pay, right? So it's a beautiful scheme, a beautiful sort of an institution. You only withdraw money when you require it. In direct stocks, you withdraw money when you feel that the stock is not doing well or the profit booking time has come. So I think all in all, mutual fund is a better option, an easier option, and a very convenient option. Okay. So now to get into the nitty-gritties of this investment. Um, so a mutual fund is a pass-through vehicle. It is not an investment avenue by itself. You invest through mutual funds, you don't invest in mutual funds, right? So just like these buses, they all look alike, but they go to different destinations, and you have to know what is your destinations to catch the right bus. So similarly, you must know what sort of a fund scheme you are investing in. Basically, as I gave you the categorization of these investments. Similarly, the categorization of funds are there, where there are equity funds, then there are debt funds, which is invest in income-oriented investments, and then there are hybrid funds, which have a mix of both. Plus, there are many variations of these mutual funds. So we don't want to get into all that. Suffice it to say for our discussion today that we want to invest in equity funds. Okay. Um, so from this, I would now get into um, easy to understand and a very popular method of investing called SIPs. Now, SIP is short form for systematic investment plan. It is the greatest gift given by the mutual fund industry. Okay. It is something where it is not an investment, again, avenue by itself. It is a process. It's an investment process. Okay. So when you invest through SIPs, you are basically easing out your processes. I mean, you just have to define how much money you are going to give away through these investments. Fill up those forms. Nowadays, actually, it is all on online. So basically, you are deciding, your amounts, and it automatically happens. Now, uh, okay, this is something. This is, of course, the features of the, SIPs, and these are the pitfalls. So basically, what I'm saying is that firstly, when you start an SIP, you are whatever is your affordability, you will start according to that. Okay, but be sure that you keep increasing these SIPs. I have people who have, at various stages in their life, they have started from 5,000. I have a gentleman who has been doing an SIP of 15 lakh rupees. Now, this gentleman whose SIP was of 15 lakh rupees, he started 25 years back at 15,000. He saw the benefits of it, he saw the convenience of it, and he kept on increasing whenever he could. So that is something that you have to understand and remember, that you don't stay with a particular SIP and, my job is done, I'm doing my investment programs. No. So, this is something which I saw last week in some social media post. The guy was saying that if you invest, and this is true, 10,000 a month SIP, and you do it for 20 years, assuming a 12% return, you will make 1 crore rupees. Now that is fine. Okay. But if you stick to only doing that 10,000, although you could do more, what will happen is you will get that 1 crore, but that 1 crore will be hardly worth anything. As we saw in that inflation graph, your 1 lakh becomes 30,000 in 20 years in value, right? So you may get 1 crore, but the value of that as at that time, 20 years later, will be only 30 lakhs. So that is not something that you want. You want your money to grow at a better pace. And that is why SIP amounts must increase from time to time. Okay, this is something I showed as a lump sum investment. Now with SIP, let's see what happens. It is all your money is going on a monthly basis, irrespective of where the market is. So actually, when the market is low, the SIP is working better. It is giving you more number of units, and it is helping with the compounding. The first sort of advantage you have, so I'm talking about the same gentleman who started at the peak of the market, but he started in SIP now. So his break even comes very low. I mean, just as the market moves, his break even is happening, and by the time it reaches the level he had started with, he's already making profits. Okay, so so this is okay. So this is another example of power of compounding in SIPs. Now just see the graph, and this is, by the way, again taking 12% into returns into consideration. 30,000 of SIP every month will give you 50 lakh corpus by the end of 8 years. But the next 50 lakh will come within 4 years. The third 50 lakh is coming within 3 years. And it says by the time you reach your 20th year, you will add 50 lakhs almost every year. Now, if you double this amount to 60,000, then you can speak in crores. This is, again, as I said, the longer you stay, the higher the amount you can expect. This is something that I have created for effect, but it's not entirely untrue. Okay. So if you want to accumulate 100 crores in a period of, let's say, firstly, let's talk about long term. So it's a 30-year period, right? What you will have to do is you will have to invest 1,44,000 per month for 30 years. Now, somebody may say, I mean, a lot of you may say, okay, this is not something possible for a person who is starting on his job or even midway through his job. I have been, my most of my clients have been from the IT industry where the packages have been very high. So even youngsters get around 25, 30 lakhs, who are single. So they can definitely afford 1,44,000 and continue in that vein. Also, I want to point out here that you remove one zero from here. So 10 crores if you want, your investment per month is 14,400 rupees for 30 years. So let that sink in for a moment. You don't require big amounts to create wealth, even with small amounts. But what did I say? Patience and discipline are two of the two most important characteristics to have. Okay. So, and also, as I said, even if you have, let's say, you start with 50,000, over a period of time, as your income increases, you can, SIPs can keep increasing, just as the gentleman I just talked about. Okay. So, if not 100 crores, you can reach somewhere in between, definitely between 10 and 100, right? Okay. Now, this is an important aspect which I think I'm almost, okay, last 4 or 5 minutes. So I will wrap it up. So why do you need a financial advisor? I am saying even if you are well versed, whatever I have talked about, suppose you are understood, you know that, or you have understood that now. Now you say, okay, now I don't need to know more. Okay, I can do this myself. Still, I would say you need a financial advisor because when it comes to your money, there is a very good chance that at various times in your life, wherever there is as I said, when there are problems or when there are even euphoric times, there would be, there is a very good chance that you could be taking emotional, impulsive decisions, which are not detrimental to your financial health. At such times, when if you have a financial advisor, he will he will point out to you the mistake that you are making and hopefully dissuade you from committing those mistakes. Okay. Now, so so in our fraternity, in the financial advisory fraternity, they say that even an advisor requires another financial advisor because with your money I am completely sort of unemotional, but with my money I would be equally emotional. So an advisor may also require a financial advisor, or at least somebody who acts as a sort of a buffer for him. So everybody needs a financial advisor according to me. Now, so here, I want to show you this example where if you go to any gym, you will see there are fit people doing exercising vigorously, but they always have a trainer. Now, if they can do everything on their own, they are physically fit, they know how to exercise, they know, what are the things that they need to do. Why do they have a trainer? And the trainer charge a lot of money. So basically, the trainers are there to point out the errors in their exercising regimen which could come up. They are there to point out, the variations that that exerciser could go through. So there is somebody looking out for you, somebody who is, um, watching out for your interest. And that is the reason you need that advisor. Lastly, I leave you with this quote. The investor's chief problem and even his worst enemy is likely to be himself. So basically, you could be your own enemy. Now, this quote is from Benjamin Graham. Some of you may not know who he is. I am expecting everybody knows who Warren Buffett is. He is the billionaire investor from the US. He considers Benjamin Graham as his guru. So I rest my case, right? Okay, there is one more slide. I am sorry, I didn't realize. Just summarizing quickly what I have talked about. One is ownership. So when you are investing into equity, it's an ownership in a business. Okay, it is not something you are doing for fun. Time, so start today, uh, because the earlier you start, the better it is for compounding, and you get a more amount of time to remain invested. Attitude to cultivate, optimism, be positive about the future, have more patience with your investments, and have the discipline to remain invested, continue the investment, and not withdrawing for frivolous reasons. I'm saying only for frivolous reasons. Okay, and you require a financial coach to for curbing your impulsive emotional actions, which could lead to financial ruin. Thank you very much. Yes, Sahil, can we
Yes, sir.
questions? Any questions?
So there is one question in Q&A section.
Okay.
So
How loan is income oriented? No, no, loan is when I say, oh, yeah, in that basket I had shown a loan. So, what I meant to say was that loan, when you give invest in fixed deposits or PPF and PF, it's a loan given to the bank or the government. So when you give a loan to your friend, suppose somebody takes money from you and promises to pay you with interest, that is also a income oriented product. That's what I mean. I'm sorry if I have given the wrong impression about it. Okay, there are more questions. Last slide. Okay. Last slide was, let me share. Okay, I will show the last slide. Before that, let me tackle these questions about best mutual fund. There is no such thing as a best mutual fund. Okay, there are so again, I'm only talking about equity funds. A debt fund will invest your money in bonds and fixed deposits and corporate deposits and so on. So what you return you get from debt funds will be similar to what the interest rates are. There is no wealth creation. So in equity funds, it is some you have to diversify. So basically, when I say diversify, I'm talking about investing in various types of equity. So, for example, large cap schemes. Large caps are all blue chip companies. So when you invest in large cap, you are actually buying those blue chip companies. Then there are mid cap schemes. Mid caps are one category lower. So they are what we call as aspiring large caps. So, these companies are, growing fast. They want to become blue chip companies, but they are smaller companies. And small caps are still smaller. They are, they are again fast growth. So they also want to go, sort of become bigger and bigger. So, as an investor, you have to be diversifying your investments into these three categories. So, large cap should be the biggest part of the portfolio, slightly smaller will be mid caps, and still smaller will be small caps. Now, which particular fund? Okay, now let me put it to you this way that trying to select a fund based on its past performance is something that is not going to give you uh, a good result always. Because, firstly, what we have observed is every previous 3 year performance, top performers in next 3 years do not always live up to their expectations. So they could go as far back as more than 100 in ranking. And this is what we have seen. Think like this. What you are investing in is a mutual fund scheme. The fund manager is is a person who is managing that scheme. So he, according to his intellect and expertise, he is thinking of companies which would do well. Now, sometimes they do, sometimes they don't. Sometimes it takes a longer time for them to do well. So a fund may have done well last 3 years, does not necessarily mean it will do well in the next 3 years, 5 years. Okay. Our time horizon is lifetime. We are saying ki I am going to remain invested throughout my life. Now, when you say something like this, what you are doing is when you want to choose a mutual fund scheme, you look at schemes which are consistently in the upper quartile. So if it is, let's say, a 20 or let's say 100 companies or 100 schemes, ranking is there of a particular type. They are not 100, maybe 50. So you will look at the top 12 companies, which is the top quartile, as we say. It is the in the top 25% consistently throughout. You may want to look at it that way. So that kind of those schemes are the ones you choose. But let me also tell you this, even the worst performing funds also on an average do well. And all this compounding that I showed you, they will give you that kind of compounding. So don't spend a lot of time on selecting the best mutual fund, and don't be disappointed if that best mutual fund that you selected did not do well for you in the next 3 4 years. Then you will have to be more patient and allow the fund manager to record, because these all these fund managers, they are basically professionals. They are doing a good job, but sometimes their calls do not prove right. Sometimes the calls are proven right after a long time. So all these things happen, right? So important thing is you diversify your money across these three different scheme categories. Choose two or three schemes per category. In fact, not even three, one or two, I would say, and keep investing in that. You can do no wrong with that. Okay, I hope I have answered your question. Okay, that last slide somebody wanted. So let me, okay, not the thank you slide, I'm sure. Um, okay. So this is it's a summary. So again, I am reiterating for the benefit of everyone, ki equity is the ownership. It is you are buying into the business which we expect to do well. Time is that the more time you spend in that investment, the better results you will see. And these are the three attitudes to have: optimism, positivity about the future, patience and discipline, and having a financial coach. Okay, now, okay, let me come back to the questions again. Equity and debt. Okay, equity and debt is that growth oriented and income oriented schemes. Equity means being a shareholder, being part of the business. Okay, when you buy a share or stock or get into an equity fund, you become a partner in those companies wherever you have invested in their progress. Debt means it's debt. It is a loan given. So when you make a bank fixed deposit, it's a loan given to the bank. When you put in PPF or PF, you are giving a loan to the government. It will always give you interest. It will not give you profits like an equity can give. Research on return and investment of investors in Vijay. Can you please give me some suggestions and ideas? Yes, you can connect with me privately. This is not the forum to, talk about this. Investment in direct gold ETF, mutual fund, or multi-asset allocation for gold. I think everybody now, because the gold has come into limelight, everybody wants to, talk about gold. So, a multi-asset fund is good for people who cannot stomach the volatility of equity by itself. Because what that multi-asset fund does is it has decided how much money will be in each asset category. So you're talking about gold. So I know one scheme where they have in equity, in debt, and in gold. These are the three asset classes. So one third, one third, one third is the amount they put in, and whenever and they rebalance every month or every 3 months, where any scheme, any of these asset class, when it goes up, they will sell from there and put it into the asset class which has gone down or which is lower. So again, to bring it back to 33, 33, 33. That could be a for somebody who is not want who cannot sort of stomach that risk of equity, who will be very hyper or uncomfortable if markets go down and if he sees his portfolio going down. Not to say that this multi-asset fund will not go down, but it will go down very low, less. And in fact, it will, because it has gone down automatically, a lot of money from gold and debt funds will come into this. So in a way, it will be beneficial also. So it's a good strategy for people who just don't want to take the risk of equity. All right. How can I invest in Nifty? Whether through the ETF, you have ETFs, you have Nifty index funds also. I would suggest go through the index fund rather than the ETF, because sometimes the ETFs are not liquid enough. So there could be a problem. If our goal is a short-term goal, which source of investing is good? This is a good question, because I want to make it very clear. When you are talking about equity, we are talking long term. We are not talking about 2 years, 3 years, 5 years even. Okay. When I say long term, I am saying forever. Okay. We invest. So when you are putting in money, basically what is SIP? SIP is the amount of money that you are not going to miss. You know for sure you're not going to even look at it, right? And you don't need that money for a long period of time to come. So basically, people who are working, who are either in business or in their jobs, they are saving money, and that save, as long as they are working, their income will keep increasing, and so they will not need this money which they are keeping aside. So equity is always for the long term. So if your goal is short term, you cannot put money in equity. You should put it in some kind of a debt fund or a fixed deposit or something. Mutual fund, I just explained that ETF is a better this. No, when you say ETF, ETF is comparable to an index fund. Now, index fund also has low expense ratios. Okay. ETFs are technically better, but as I said, sometimes if there is, I think the Nifty index fund has a good liquidity, but not many others. So, uh, if it is a Nifty index that you are wanting to invest in, you could go the ETF way, but otherwise, index fund could be a better answer. Yeah, so invest in Nifty. Uh, should I go for SIP or equity? So SIP and so SIP is SIP in equity. Okay. When you say equity, I'm talking about equity mutual funds, not stocks. Invest in Nifty, whether through, okay, the same question. A lot of people have asked this question. So again, I'm repeating, if you want to invest in Nifty, ETF could be the answer, could be the better option. But if you're, for example, if you're doing an SIP, ETF means you give a transaction in the market, you give an order in the market. You may tend to forget. So Nifty, if you a Nifty index fund SIP will relieve you of all that hassle. That is why you can, if that is the case, then you can get into the SIPs through Nifty index fund. Otherwise, ETF is good. Why stock price is not moving but profit increases continuously, good balance sheets of some companies. So this is the point I am making, that market sometimes uh, goes down due to sentiment. Nothing is wrong with the companies, nothing is wrong with their businesses, but sentiment. And that is why I said during these times when the sentiment is bad, it is not as if the market has, all of a sudden companies are doing badly. And that is the reason why you have to show patience. This is an anomaly. It will pass. Markets will go up. Generally, you will see that good companies, survive the bad periods and thrive in good markets. So you want to ride that period of recession, and then you will really zoom when the market turns, or when the market turns for the companies and profits come. So basically, the stock market is not always a good indicator of what is happening with the businesses. Okay. So and that is why patience is very important to have. How can I invest in equity? Oh no, so these are all the same. This. So again, madam, short-term investments resource is your debt funds, and any short-term deposit that you have. There are a lot of, in the debt category, there are liquid funds, money market funds, ultra short-term funds. All these are investments which you can get into. But if you don't understand mutual fund, there is nobody to guide you. You can put the money in a fixed deposit for the short term through direct AMC or third-party mutual fund app. Well, I am not aware of apps, okay, how they work and all that. I don't know for sure. So I'm not going to guide you on apps. But there are mutual fund distributors. When you say directly AMC, you'll have to go through all the hassles of doing things on your own. Better get connected with some mutual fund distributor who will do all the work for you. Okay. So I think I've completed all these questions. Um, Over to you, Sahil.
Yes, sir. Let me check. Um, I think you have answered, sir, all of the questions
Yeah,
which
yeah.
were asked by the attendees. Yes, yes, sir. You have answered all of the questions. So I think we are good to end the session, sir.
Yeah.
Yes. Thank you so much, sir. Would like to extend your heartfelt thanks for taking time and speaking at the webinar. Your insights, expertise, and a presentation as well has truly made a lasting impact on our audience. And also the Q&A session which you took now. Thank you. Thank you so much,
Thank you.
sir,
Thank
again
you for
for
having
sharing
me.
your time.
Yeah, yeah.
Yes,
Thank you.
yes. Thank you.
Bye.
And also thank you to attendees as well for joining in today. Thank you. Thank you all for joining today. Thank you.
Thank you. Bye.
Yes.